My Portfolio. Pimp My Portfolio.
This is a segment where we bring in an expert to review the portfolio of a community member. And today our expert is Adam Dawes. Adam, welcome.
Thank you so much, guys. It's great to be here.
Very excited for this one. Before we crack into it, a reminder that Adam is offering a professional health check on your portfolio for $750. You can go and speak to him and his team and get a limited scope personal advice, statement of advice, I should say, on your portfolio. So head to equitymates.com/advice and we'll hook you up with Adam and the team. But without further ado, we should welcome our community member, Nicole. Welcome to Equity Mates.
Thank you. Great to be here.
Now, plenty in this portfolio. So, Ren, why don't you take us through it?
Yeah, okay. So Nicole, she has a number of ETFs and then a number of individual stocks. So starting with the ETFs, the portfolio is anchored by three big, geographic ETFs. We've got Vanguard S&P 500, Vanguard All World ex-US, so the complement to that US ETF, and then Vanguard Asia ex-Japan. Together, they make just shy of 60% of the portfolio. Then there's a number of other ETFs. We've got Vanguard Diversified High Growth, a Crane Shares China Internet ETF, BetaShares Global Cybersecurity, BetaShares Global Sustainability, Global X Battery Tech and Lithium, ACDC, and finally BetaShares Cloud Computing. So a number of thematic ETFs there. And then finally, we've got some individual stock holdings, Spotify, Coinbase, Telstra, Woolworths, Endeavour, Stellar Metals, Adore, and New Hera Limited. A tiny allocation of Bitcoin, and then about 7% of Nicole's portfolio is in an employee share scheme. So,
wow,
a lot there. Hopefully everyone followed along. But Dawesy, we always like to start with a nickname for these portfolios. So what have you got for us today?
Nicole, because you hold Adore Beauty, it is an adorable portfolio.
Wow.
This one is looking really, really good. There's a couple of things that we'll talk about to sort of get it back into shape. But at the moment, it's looking pretty good. But however, your Adore Beauty position probably isn't.
Oh, that was shocking.
Right. So anyway, it is an adorable portfolio.
Was that the type of nickname or feedback that you were expecting, Nicole?
I'll absolutely take that. I'm quite happy with that.
Absolutely.
So Nicole, before we get into some of Adam's general advice and tips, maybe tell us a little bit about how this portfolio came to be and how you're approaching investing today.
My investing journey started off quite similar to yours, Ren, in that my first stock pick was an absolute shocker.
Nice.
It was New Hera, the last one you mentioned there. I bought it off a stock tip from a friend. I did none of my own research. I put far too much money in and I bought on the way down. So they've recently gone into voluntary administration. So it didn't end well.
Look,
and
we've all been there,
investing
Nicole.
for a few
We've
years.
all been there.
Yeah. But yeah, it put me off for a bit. So I didn't do anything after doing that until I discovered ETFs and started dollar cost averaging into VOO. And I did that as my sole core for a couple of years before I had, I guess, a meaningful amount to invest across multiple things and decided to diversify. And you can sort of see the journey that I've been on in my portfolio. I tried the thematic ETFs, I tried VDHG, both of them I don't think for me long term. And yeah, I've sort of settled on my 3 ETF core. And then obviously, as you mentioned, have that large position in my employer that I've actually sold down on recently within the last fortnight. So it's not as big as you see there, but it's still probably about 6%.
I was going to say, have you ever sold anything?
No, well, that was my first ever sale.
Nice.
I've got things earmarked to sell, but haven't actually made the jump yet.
Made the jump.
Well, it'll be interesting to see if what you've earmarked and what Dawsy's about to talk about align. So, Dawsy, where do you want to start? What stands out to you here?
Yeah, so I think the core versus satellite kind of approach, which we've all talked about, is the right way to go. So, Nicole, I think you're in the right space as far as getting those Vanguards, S&P 500, All World ex-US, perfect. And then Asia versus ex-Japan. Probably the Asia one or the Japan one's actually started to really move over the last 6 months. So being ex-Japan probably has hurt a little bit, but I still do like that Asia exposure. So I think you definitely need that. From there,
Yeah, well, Japan's covered in VEU too, so I've got a little bit of it.
okay, all right. So in the Earl world, yeah, okay, yep,
Yeah.
yeah, absolutely. So then from there, you've got your diversification within your thematic ETFs, which I think are great. We don't want to get caught too much. You've got to sort of look. It's okay weighting 2 to 3% in those thematic ETFs. I think that's okay. Each holding, you're not 10%, 15%. So you can have some of those thematics. That K-Web one has been a really great one. I think you'd be doing really well on that Crane Shares one going forward, and certainly like the hack as well. That global cybersecurity. That theme, I think, is just going to continue to keep going, and we're going to need more and more of that. So I like that one as well. The ETHI, the Global Sustainable Leaders, has been a good one also. It's had its a couple of bumps up and around, and ethical investing has certainly taken a back seat. I know a lot of younger people still feel it being something that they really should look at, and we should, but it really has taken a back seat at the moment. So it's probably one to keep adding to or looking at as well. So yeah, I think overall the portfolio looks really good. You've got some international individual stocks, so Spotify, Coinbase Global. So you've got some individual ones. Are you buying them just directly via the platform that you're on? Is that how you're getting them?
Yeah.
Yeah. Okay. So that's great. And are you watching those pretty carefully?
I am. I topped up both of them when they had dropped a bit. I think end of 2022. I don't think I've purchased since. But I do keep an eye on them.
Spotify is fantastic. That thing is just going to continue to keep going on with. I think they're up to $26 for the family premium now. It's ridiculous, but everybody's paying for it. So yeah, absolutely. So I think everything's there and it's looking really, really good. You did want to touch on employee incentive schemes. One of the things that when people have work for a large company, let's say it's BHP, they get access to have the ability to buy shares with some of their wage, and by dollar cost average or putting a couple of $100 aside each month, which you don't miss it, getting into that, and then usually and sometimes the employer actually tops up the amount of shares. So all your staff at Equity Mate should
Once we're listed.
Don't worry about that, Dawesy.
So I think you're on the right track with keeping that employee incentive scheme going. When you're inside a company, and there's a lot of people, like I say, BHP, that have a lot of BHP shares, but they go, should I sell some? And well, no, because you're in the company and you're making the company work. You can actually see inside the company, which a lot of people can't, and you can see the benefits of that. So I think in continuing to do that over time, especially if the price is depressed a little bit, it sort of feels like you're collecting worthless bits of paper at the moment. But what it does and will show is that over time, if you feel the company is still going in the right direction, I think that's something that we should definitely look for, and keeping up that employee incentive scheme.
Now, Dawesy, there is a bit of an assumption there because you've said that you're inside and you can see that the company's going in the right direction.
Yeah.
But I think there's people on employee share schemes that might be doing it because their employer might be topping it up, or do they get to use do you use your before tax income to buy it? Yeah, so there might be other benefits, but they might not feel like their company is flying.
Yes.
And Nicole, we have no idea like what you think about your company. We haven't asked you. So but in that situation, how would you approach an employee share scheme?
I think it's worthwhile just putting money away, having most of your audience now is worked out that dollar cost averaging is the right way to invest, and it absolutely is, and it should be with an employee incentive scheme as well. I think you just continuing to put it away, a couple of $100 a month, whatever it is, you don't really realize it, and you're getting the benefits of building part of the portfolio. Now, if it gets to 50% of your portfolio, potentially then you might want to sort of pull it back a bit, but with a sort of 7 or a 5% weighting, I think you're okay. And if you've got the view that this company is going somewhere, because you wouldn't be there if it wasn't going somewhere, I think you want to bet that it is going to do well, and then that will pay off in huge dividends further on down the line.
How do you think about that, Nicole? Does that help you think through it?
It does. I think there are a wide range of outcomes for the company that I work for, so that doesn't really help. But most of the balance is gifted. So I'm not paying and having it matched. That is part of it, but
Okay.
they stopped that program, and it's just part of my REM. So assuming I meet the vesting conditions, I just get a
Good.
parcel of shares every financial year.
Jeez, that's
So I'm not putting my own money into it, which is great.
That's pretty nice.
Yeah,
Yeah.
absolutely.
Yeah.
Absolutely.
Well, then personally for me, then Dawsey, it would come down to whether or not you think there's a better investment opportunity. Because if you're not putting money into it, you're getting gifted stock that vests. It's like I could sell that and invest it into something that I think is better than the company that I'm currently working at.
Yeah.
That's
You're right. I mean, it's certainly that you want to be putting money into where things are growing in the right direction versus stagnating or going backwards. Yes. However, it didn't cost you anything. So there's a big tax issue for people with employee incentive schemes. And it's another way that the company can handcuff you to keep in there because the shares don't get vested for 6 months, even to 12 months, even 2 years sometimes.
Yeah.
So even if you leave the company, then half of those shares disappear, right? So you got to look at it. There's a classic example where resource brokers, when the market's down and all they're doing is they're collecting worthless bits of paper, but they know that pieces of paper, which is share certificates, it's going a little bit old school here, but share certificates, that's going to turn around one day. It is going to do well. It's just, so how you look at it, but keeping that incentive scheme moving forward, I think is the right way to do. And it's certainly part of your REM, then I wouldn't say no to it. I would continue to hold it.
Okay, great.
Just if we turn to the individual stocks. So on one hand, you've got these sort of high flying tech companies over in the US, and you bought them at the right time, and I'm sure you've done very well on them if you bought late 2022, and I'm talking about like Spotify and Coinbase here. And then on the other hand, you have perhaps some of the most boring and slow growing Aussie companies in Telstra and Woolworths. And I don't mean that as a criticism of you. I do maybe mean that as a criticism of Telstra and Woolies. But how do you think about approaching individual stocks and that side of your investment?
Yeah, so I think that attitude has changed over time. Telstra was one of the first, and that was just like a recommended by the parents, good stock, safe stock, whatever, get the dividends and then go from there. Woolworths was a Endeavour play, so that was not long before the demerger. And I probably should have sold soon after in hindsight, but that's fine. I think my attitude sort of shifted to become more of a or to focus on more of the growth stocks, given that I am, in my 20s still, have enough to invest in things that are a little bit more risky that could return a little bit more. So that's where I'm sort of focused at the moment.
Dawsey, and then I'd love to get your view on that, but like particularly in the context of this portfolio where there is such a strong weighting to like an ETF core already. Yeah. So how do you think about like those blue chip, the Telstras and the Woolworths alongside like a big core weighting?
Absolutely. I think you're in the right area. It's core versus satellite. So yeah, absolutely. Keep going with the blue chips. They're good quality businesses. There's not too much overlap because you don't really have an Australian ETF or an index ETF. Yeah. So potentially
that was deliberate because I was investing in Australian stocks. I figured I'd be overweight Australia, and so I didn't want to be overweight Australia in ETFs as well.
Yeah, you wouldn't be overweight with the shares that you've got. Remember something like an A200 or a VAS, or you like Vanguard, so I'm saying the VAS, which is the top 300 stocks, and the A200 is the top 200 stocks. You wouldn't be overweight in the Australian market by having that diversification. So potentially looking at getting an Aussie index, because the way you've sort of positioned the Telstras, the Woolies, they're good businesses. I know one of you used to work for...
I was at Woolies.
Bryce was
there
at
we
Woolies.
go.
Actually, and Bryce used to work for Telstra as well.
Oh,
yes.
So this is the Bryce Lesky portfolio.
And I've done a stint through Endeavour. So.
We should have nicknamed that differently. Anyway, I think getting those, but then you've got Stella, Adore, and Nuheara. So that sort of feels like you're just throwing a dart at a dartboard and sort of having a bit of a guess there. So I'd look at an A200 or a VAS, a Vanguard 300, and then potentially looking to bring out the individual holdings. Remember, you potentially want 30% of your portfolio in Australian equities. Okay, so
Yeah.
you could actually build that side of things, and then I'd look for good quality blue chips that have got a good growth profile. BHP is a great one, but then also some of the banks. There's plenty of other stories in there, and some of the tech stuff in there. You've got the cloud, you've got cybersecurity, those kinds of things. They're more international. We've got some really good tech businesses here in Australia that look really good as well. So building that out a little bit, I think, is something that would definitely help the portfolio moving forward.
Love it. Well, thank you so much, Nicole. Plenty to think about there from Adam. But I think overall, look, the core of your portfolio is certainly set up for the long term, and looks like you're doing pretty well on the individual stocks as well. So thank you so much for submitting to Pimp My Portfolio and taking the time with us today. We do really appreciate it.
Yeah, thanks for having me. Good to know I'm roughly on the right track.
That's it.
Well done, Nicole. Keep going. And thanks for braving the segment and sharing your portfolio with us today.
Thanks, guys.
If you would like to submit to Pimp My Portfolio, head to equitymates.com/contact. And if you would like a professional portfolio health check with Adam Dawes and his team, you can head to equitymates.com/advice, and you'll find all the information there, and we'll be able to connect you with the team. But Adam, as always, thank you so much.
Yes, thank you.
Ren, we'll pick it up next week.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.